Hey guys, welcome back to the Lazy Equity YouTube channel. I'm Daz, and today we're going to be talking about the most important topics in property investing. Supply and demand. Now I know that sounds really boring, but stick with me because once you understand this, everything will click. And I mean everything. Here's what we're covering today. We're going to be taking a look at supply and demand and how it actually works inside property markets. We're going to have a look at 3 completely different suburbs across Australia, and we're going to break down exactly how that data looks side by side for each one of them. Oh, and before I get into it, if you haven't yet watched our other video around the big picture of economics in Australia, definitely go and have a watch of that. That's going to help really put a lot of the understandings in place before you get into this video. Otherwise, head back to it afterwards. Just make sure you watch it because it's going to put a lot of comprehension in place for you. While I'm at it, make sure you like and subscribe so you get the updates for all of our videos each week that we put out. Okay, let's go. So this is a tool called Crystal. Crystal is a proprietary technology that we've developed inside the Investors Agency. For those of you who don't know, the Investors Agency is the buyer's agency that I run with my team here in Sydney. Now, Crystal analyzes 13,000 suburbs for us each month, understanding what is happening for up to 4 years ahead for the buying and rental markets for houses and units within Australia's property landscape. And in today's video, we're going to use Crystal and I'm going to walk you through 3 markets. We're going to have a look at the data and break it down into plain English so that we can understand what's actually happening inside these areas that has either driven growth or expected to drive growth into the future. And if you have watched that video, which I referenced earlier, and if not, go back and watch it, but you would be familiar with the idea that demand and supply metrics do not change, that they will always be the demand factors that grow property prices. And in this video, we're going to uncover that. It doesn't matter if it's a $300,000 property or a $3 million property, the fundamentals still exist. So our first market is called Taylor. Now Taylor is in the ACT, it's a fringing suburb to Canberra. Taylor was developed in 2017. Now, there's something really important that we need to understand around new markets. When a developer puts down a lot of stock inside a new market and essentially creates a new suburb, what's happening inside that area is that a new price point is being created, but it's being created by developers, which is quite typically the upper end percentile of any market around the area that it's surrounding, making it more unaffordable to the local population inside those areas. And we can see that by this trajectory here, where the price movement went down for a couple of years until it hit the price point where it was neutral back to its original value at around 2020. The full correction from 2017 to 2022 took 5 years. And that's where we could start to see the property prices realizing the affordability according to the incomes earned from the people inside those areas. And that's really important to remember, that when you're buying new stock, you're buying it at a premium price because it's a premium product. But as soon as you buy that product, you're immediately depreciating that value off the bat in day one. And that correction can take up to 5 years to correct itself, as we've seen over here. The correlation to new stock being sold, we can see here, isn't as attractive to the local population that are trying to buy these properties, because as you can see, the days on markets are far significantly higher than the stock on markets. But when we get to that stage in 2022, that's when we realize that, okay, great, these price points are now starting to make sense. And that's when the time on market and stock on market equally traject at the same pace. And that's when we can start to see a healthy climate inside a property market that makes sense for the local demographic that are buying these assets. But as time goes by, we can see that when we get closer to 2024, hitting that sort of 39% unaffordability bracket, the buying starts to slow down in this area. And that's because the people who were buying the properties just can't really afford that anymore. The demographic profile doesn't support the price range. And we can see that inside the actual purchase price starts to lull out around the same time. So in around September of 2024, property prices were around $994,000, and today they're sitting at about $1.04 million. So not a lot of growth in that time period. There needs to be a relaxation inside this market, but it's done really well beforehand. So people who bought properties inside that area have done pretty well. It just takes time for new stock to settle off the valuation compared to the rest of the market where that asset sits. The median needs to be realized, and you don't want to pay premium prices for median price stock. And in simple terms, you shouldn't overpay when you simply don't need to overpay, because the reality here is that if you were to purchase this property from build date until those 5 years of recovery, you would have been paying a significant amount of interest repayments on that loan in that time. And that's typically why we don't like to buy new stock. We want to be in established markets with established medians, not buying above a median that's overinflated by developers. And this is a really good explanation, an example of that when people have the ability to buy, basically when things are affordable, there's more chance that they will buy. When people cannot afford to buy, when things are unaffordable, they simply won't, and so buying stops. If you've ever wondered why a property market that you've been watching has all of a sudden stopped growing, drop the name of that suburb in the comments below and we'll unpack that in your reply. All right, market number 2 is Munno Para West, and this is sitting on the fringes of Adelaide in South Australia. It's a very exciting market, at least for the data and property nerds like myself. I've got a property inside the suburb specifically, and it's performed very well. And these are the reasons why. We're going to unpack that right now. So over the past 4 years, Munno Para West has gone up by 97%, which is a fantastic return to say the least. But it's because all the data lines up absolutely perfectly cleanly. There's the right amount of stock, the right amount of time, the right amount of pressure, and the right amount of affordability. All 4 of these need to synchronistically rise and fall at the same rate for it to fundamentally make sense for a healthy market to continue to grow. Back in 2023, the affordability within the area was sitting at 29%. Looking today, we're in 2026, and the property market's affordability rate is sitting at 36%. Now, considering the fact that the property market has gone up significantly in that amount of time, yet the affordability is still there, this tells us that the local economy is really supporting wage growth inside the area. And that's kind of why we like Adelaide so much, because there's been a really strong foundation within the metropolitan areas that stimulate the fringing areas around it too. And this is the quintessential indication of a healthy suburb. When we know that property markets can move and they can do so while keeping it within reasonable affordability, these are the types of markets that we really like to find for our clients. For those of you who don't know, I'm the founder of the Investors Agency. We're an investment property buyers agency. If any of this is of interest to you, contact our team and our property analysts will run you through the process that we go through to find the best property markets inside Crystal, with a live demonstration showing you exactly how it works. Another really strong signal to look for here is the listing and accepted prices over that same period of time. When you've got such a small variant between listing and sale price, there's clearly just an unrecognized amount of goodness and health inside this market, where there's just not enough competition for it to overinflate. It's just the right amount of competition for the price to go up at the rate it's going up without it stepping far out of whack to be either overpriced or underpriced. Keeping the median price point within the sales affordability is exactly what drives that market to continue to grow into the future. On top of that, the vacancy rate is sitting at just 1%, and we've only got 21 days on average for rental properties to be consumed once they go listing to being taken off the market. A very healthy residential investor market as well as the home buyers market. So both ticks on both sides. Now, the really exciting part around Munno Para West for me is around the fact that it has so much room to gentrify. Gentrification comes from the understanding that a population will be able to come into a market and spend money and basically change and develop into a more wealthy clientele. This is what we're looking at the moment is called a CIFA rating. It lets us understand how well educated or unemployed the area is, or how much money the local population have in terms of affordability inside their homes, and also what their employment rates look like inside the area, and potentially how disadvantaged or advantaged this demographic is. The closer into the center there is means there's more opportunity for growth into the future. And when we have price points that are within affordability to grow within these areas, then pretty much growth is on the horizon. It's just about how much there's going to be coming. This is quite typically the suburb that has got all the ingredients for the perfect investment return. Okay, so market number 3. Now, I know this one's going to raise some eyebrows. Port Augusta. For around $50,000, you can get into a market just like this. $50,000 bucks, that's all it takes. Now, I want to be upfront with you guys. Port Augusta, a market like this is definitely a more volatile market, but that doesn't mean it's a bad market. It just means that it serves a certain purpose. Markets like these are typically driven by more specific industries like energy or mining or manufacturing of some sort, or potentially wheat. Now, that just means that you really need to pay close attention to the decisions that you're making if you're going to go into a market like this. Quite typically, if they are single economic markets or lower variety economic markets, meaning that there's like a single industry that's actually powering the area, such as a mining town, you have to be very, very attentive to what's going on inside that area. But with that context in mind, let's go have a look at the data and actually see what's going on inside this area. So 4 years ago, you were able to buy a property at around $157,000. That property is now worth around $290,000. So under $300,000 currently is where the median sits inside this area. And in that time, there's been some really steady growth. But that hasn't always been the case. And quite typically, that's never always the case. There's always going to be a correction of some sort. But this wasn't too bad. This just really meant that the industry hadn't picked up yet within the area. There's not been a crash. There's been a rise mostly for the last 9 years, which is a pretty good increase considering if you bought there 4 years ago, the property market has gone up by 88% in that time. And if we look at why, we can see here that the days on market and the stock on market have both fallen at an equal rate. This has continued to drive demand within the area. Again, supply and demand are still the fundamental drivers of what push property prices up or down. Looking again at the fundamentals when it comes to affordability, it's an extremely affordable market. This means there's got a lot of potential for movement, but because it's a volatile industry market, it is subject to questioning whether that local population actually have the funds for it, because a town like this is generally also quite heavily invested in FIFO, fly in, fly out work. Yet it still seems balanced to have a vacancy rate sitting at 2%, and remember, anything below 3% is a demand rental market, but it is at the 2%, which is creeping closer towards that 3%. However, days on market are still sitting at 23. So there's clearly a requirement for the types of properties inside these areas. We're also looking at the CIFA rating, and we can see that there's a large amount of room for improvement on the gentrification scale. But again, because this is a fly-in, fly-out market, it's unlikely that that gentrifying nature is going to take place because people really go there to work and then they fly home where they usually live. For an investor who wants to get started in property investing and they've got a really small budget, these are the kinds of markets that if you do pay the right attention to, can really get you to your next property a lot faster. Yes, there's the whole capital gains tax argument that's just come out from the federal budget, but keep in mind that equity is not being affected by capital gains, meaning when you grow that value up, you can still pull that away to put it into a purchase of a new property using the deposit from the equity of your last one that you've just created. There is no tax on this process from the federal budget announcement. Just keep in mind that property markets like these are not forever plans. They are typically launch pads, and they should be respected with a very close eye on your decisions. If this video is landing for you guys and you like this type of a content, please subscribe and follow so that we can put out more content like this for you guys to get your education levels up of property investing in Australia, to make sure that you're making informed decisions around the right assets and the right locations to buy in. The top metrics as a property investor that you really want to look at is your supply, your days on markets, your amount of vacant properties for rent inside the market, the number of rental properties on the market, and your price movement historically, so you can understand pretty much where it is in its cycle. Because property markets don't typically tend to run and grow for more than 7 years at a time before they hit a correction phase. Now, the correction phase is going to happen all throughout Australia. Every single property market will go through corrections, and this is because the unaffordability hits in eventually. But the trick is to get into the right property market at the right time so you can build that equity and repurpose it into new assets in a timely and structured manner. Getting the right property and getting the right market is a key to doing this successfully for property investors. Alright guys, that's it for today. Thank you so much for giving me your attention. I hope this has been a help to clear up some questions that you might have had around property investing as we go into 2026 post the federal budget announcement. The big picture here that I'm trying to paint for everybody here is that the fundamentals will continue to drive property prices in Australia. And again, if you haven't watched that other video that really paints the big picture of understanding how the greater landscape of property investing in Australia looks and operates and the exact reasons why, go have a look at that one. Until next time guys, thank you so much for paying attention to this episode of the Lazy Equity YouTube channel. Until next time, keep well.